Seller financing looks like the easiest path to real estate wealth. No bank approval, no credit check, no traditional lender breathing down your neck. Just you, the seller, and a handshake deal. Sounds amazing, right? After 30+ rental properties and managing millions in real estate AUM, I've learned the hard way that seller finance deals hide costs that can absolutely obliterate your returns. And today, I'm walking you through exactly what those costs are, so you don't make the same mistakes I've seen investors repeat over and over. Let me start with why seller financing is even attractive in the first place. In my experience, seller financing becomes a tool when traditional lending tightens. We saw this happen in 2022 and into 2023 when mortgage rates climbed above 5%. Suddenly, buyers couldn't qualify for traditional mortgages on properties worth $400,000, $500,000 or more. Median home prices in markets like San Francisco were hovering around $4 million, Los Angeles around $680,000, and even secondary markets like Austin were pushing $520,000. When a buyer can't get conventional financing at those price points, they turn to creative solutions, and seller financing becomes attractive to both sides. But here's what I've seen happen again and again. Investors get so excited about zero down, no bank approval, and the ability to close in 30 days instead of 45 days that they ignore the structural problems built into the deal. I had a client last year, let's call him Marcus, who bought a 4-unit property in a secondary market for $385,000. The seller financed $320,000 at 7.5% interest over 25 years. Marcus thought he'd found the deal of a lifetime. No traditional bank, no appraisal, no extensive underwriting. He closed in 3 weeks. 3 years later, Marcus wanted to refinance because interest rates dropped and he wanted to cash out equity. But there was a problem. The seller had included a due-on-sale clause in the financing agreement. Any refinance, any sale, any assumption by another buyer would trigger full payment of the remaining balance, roughly $305,000. Marcus had already put in $35,000 in capital improvements. He was stuck. He couldn't access his equity. He couldn't leverage the property further. And by that point, his actual return on the property after accounting for the 7.5% interest rate versus the 4.2% he could get with a conventional RFI had compressed significantly. That's the hidden cost nobody talks about. You think you're getting a deal when you're actually getting locked into a financial straitjacket. Let's talk about interest rates because this is where the math gets brutal. In 2024 and early 2025, conventional mortgages on investment properties are running between 5, 8 and 7.2% depending on your credit, your down payment and the property type. But seller finance deals, I've worked with investors who accepted 8, 9, even 10% interest because they had no other options. And here's the insidious part. You're paying 200 to 300 basis points above market for the privilege of avoiding bank scrutiny. Over a 25-year amortization, that difference cost you tens of thousands of dollars in interest payments. Let me give you the math on Marcus's deal because it illustrates this perfectly. He financed $320,000 at 7.5% on a 25-year amortization. His monthly interest in year one was roughly $2,000 per month. But a conventional loan for the same amount at 6% would have put him at roughly $1,600 per month. That's $400 per month, $4,800 per year in extra interest costs. Over 25 years, that adds up to over $120,000 in additional payments. Now multiply that across multiple properties, and you can see why this matters. But the interest rate is only the beginning. Here's what I've seen trip up investors consistently: the balloon payment clause. Most seller finance deals don't run the full amortization. Instead, they run for 5, 7, or 10 years with a balloon payment at the end. That means after making payments for 7 years, you suddenly owe a lump sum, sometimes $250,000, $300,000 or more. I worked with an investor 2 years ago who had a balloon payment come due in a market where property values had actually declined 8%. He couldn't refinance because the property was now worth less than he owed. He couldn't sell without taking a loss. He had to negotiate with the seller for an extension, which cost him additional fees and interest rate increases. Now let's talk about cap rates, because this is where the real damage shows up in your portfolio. Cap rates for residential rental properties typically sit between 5 and 8%, depending on the market. Commercial properties run higher, 6 to 10%, because they're riskier and less liquid. But seller finance properties almost always compress your cap rate because your cost of capital is higher. Let me show you why. Imagine you're looking at a property generating $28,000 annually in net operating income. That property costs $400,000. Your cap rate is 7%, that's the $28,000 divided by $400,000. That's a solid residential deal. But now let's say you finance it with seller financing at 7.5% instead of a conventional mortgage at 6%. Your annual debt service just increased by $4,000 per year. Your net cash flow drops from $28,000 to $24,000. Your effective cap rate just compressed from 7% to 6%. You're making less money on the same property, and you've lost leverage and exit flexibility in the process. I've seen investors rationalize this by saying, well, at least I have zero down. But that's not actually true. Zero down means you have 100% leverage, which is extremely risky in a market downturn. When I reviewed a portfolio for an investor in 2023 who'd done 5 seller finance deals with zero down, he'd created a house of cards. One market correction of 10% would have wiped out his entire equity cushion across all 5 properties. He had no safety net, no flexibility, no room for error. Let me talk about the most dangerous aspect of seller financing: exit strategy. This is where the hidden costs become existential. With a traditional mortgage, you can refinance, you can sell. You can take a 1031 exchange within the IRS 45-day identification period and 180-day closing period to defer capital gains taxes. But with seller financing, if that due on sale clause is in the note, and in my experience 85% of them are, your exit strategy is compromised. You can't refinance without triggering the clause. You can't do a 1031 exchange easily because the seller has to consent. You can't sell to another buyer unless that buyer assumes the note, which means the buyer has to accept the seller's terms. That's not flexibility, that's a cage. I worked with a client, Sarah, who bought a duplex with seller financing in 2019. She paid $320,000, financed $280,000 at 6.5%. Everything looked good. But by 2023, she wanted to move to a different market and deploy her capital into a 1031 exchange. The problem: the seller wouldn't allow an assumption, and the due on sale clause meant refinancing to another lender wasn't an option. Sarah had to sell the property in a cash deal, take a discount for that illiquidity, and lose 6 months to the process. By the time she closed, she'd missed the window for a full 1031 exchange. Her capital gains tax bill was $47,000. That's a hidden cost that came directly from the seller financing structure. Here's another angle most people miss. Seller financing attracts a certain type of seller, and that tells you something about the property. I've seen investors think they're getting a deal because the seller is offering financing, but often the seller is offering financing because they couldn't sell the property on conventional terms. Maybe the property has structural issues, maybe it's in a declining neighborhood, maybe the cash-on-cash returns are so weak that traditional lenders won't touch it. The fact that the seller is willing to take back financing can be a signal that the property is riskier than it appears. That's a hidden cost in the form of underlying property risk. Now, I'm not saying seller financing is always bad. In my experience, it works in specific situations. If you're buying a discounted property in a down market and you have a clear plan to refinance when rates drop or values recover, that can work. If you're buying from a motivated seller who will give you meaningful terms, below market interest rates, no balloon payment, or a long amortization, that can make sense. But in today's market in 2025, when rates are competitive and lending standards are reasonable, I rarely recommend seller financing unless you have a specific edge. The data backs this up.